That is right. Ulta Beauty stock reported earnings yesterday, and we're going to take a little bit of a dive into them, see what they have. Ulta has been a stock that's been intriguing me for quite a while now. If you look at the pricing of this stock, obviously over the past month, down 29%, pretty much similar with what the market's doing. Um, but this is a stock, though, if you look 5 years out, this was a $150 stock back in 2015 at one point, and it cruised to over the $300 range. I mean, this thing was, well close to a 52-week high on this thing is 368. Right now, sitting around 200, so it's nearly lost half its value since those highs. And you pick it up from these high points, it's 42% down around there, which is crazy stuff. So definitely a stock that's been interesting me. So I'd like to look at these numbers and see what's going on, and I'll show you why this has been interesting me. So let's look at these earnings, and we see some ads. There's a little pop-up ad. So Ulta Beauty, quarter four non-GAAP EPS of $3.83 a share, which beats by 10 cents, and a GAAP EPS of $3.89 a share. Are you kidding me? And that beats by 16 cents. Are you kidding me? Is that a joke? Those numbers are ridiculous. I mean, that's profitability, this is big tech level profitability, which is crazy to see from a retailer. Ulta Beauty, one of the biggest cosmetics retailers out there, this company is making massive profit. From a revenue perspective, you see $2.31 billion of revenue this quarter, up 9% year over year, which beats by $20 million. I mean, that's massive, massive profit. It's super strange to see that from a retailer, too. You typically don't see profit at that level for many reasons. So, I just find that strange. Those numbers are ridiculously good for this company, and I can tell you that management runs this company very well if they're able to put up those numbers in an industry where retail's kind of rough. Retail's been rough lately, so after today, Ulta Beauty's somewhere right around an 18 PE ratio, which for retailers is actually pretty high, all things considered, for the time being. But regardless, I think this company's run very well, and I think it does deserve that higher multiple for a good reason. Stocks run well, so let's take a look at more of these more numbers. Over on the right here, you see this dude's name is Janus, and I don't know about that one. I don't like that. That was a joke, by the way, but Ulta Beauty gains after comp sales expectations with a 4% gain in comp sales in Q4 versus a 3.4% consensus. So they beat on a comp sales. Obviously, you see a little bit of beat in revenue, but transactions were up 1% and average ticket was up 2.2%. So all good metrics that you'd like to see. Gross margin was up 10 basis points to 35% margin versus a 34.8%. I mean, that's a very good margin for a company like this. I mean, no doubt about it. The retailer points to improvement in merchandise margins driven by marketing and merchandising strategies, partially offset by investments in salon services. Looking ahead, Ulta Beauty sees for the full year revenue growth of 7 to 8%, an EPS of $12.55 to $12.75 versus a consensus of $13.05. They say that no coronavirus impact is embedded in the guidance, so the guidance is actually a little bit lower in terms of profitability than the consensus, but I think they may, in fact, be softballing it because of potential impact. Anyone working retail right now probably can understand the impact that this current epidemic we're having. I hate to call it that. I do think there is a little bit of, definitely some overhype going on, but regardless, supply chain is being disrupted. There's no doubt about it, and I think we'll see it for a good, at least another month before things start to steady out. I mean, there's, obviously companies sending people home, not having them work, quarantining them off. So overall, we'll see an economic slowdown, no doubt, which will hurt supply chain for companies like these for sure. So definitely something to consider, and I think they may have baked that into the full year guidance. as much as they don't want to say it. But on top of that, obviously, they have initiated a $1.6 billion repurchase program. Holy crap. And again, I mentioned it. Share repurchases are good for many reasons. In my perspective, I believe it's really good because of the fact that if the company's buying their own stock, they believe it's at fair value. They believe it's good value for that stock. If the company's buying it, I think there's a good reason why investors buy back in as well. But I mean, that's crazy stuff. $1.6 billion is good. And obviously the company has money because it's so profitable. So let's take a look at some of the fine details here. So net sales increased 8.5% to 2.3 million, 2.3 billion. Really, I don't know what the heck the reason for that is. 2,300 million. Who would say that? I get it. They want some specific numbers, but still. Comp sales 4%. Obviously, we talked about gross margin. Selling SG&A expenses as a percentage of net sales increased. So definitely a little bit more in terms of selling general and administrative expenses going on there. Primarily due to investments to support future growth. Pre-opening expenses increased to $3.6 billion compared to $2.4 in the fourth quarter. Real estate activity in the fourth quarter. 13 new stores and 2 relocations. So they're adding stores too, which is good to see. Operating income increased to $287.8 million. $287 million. Yikes. That's a lot of money. Tax rate was 22.7 compared to 24% last year. So obviously a good impact on some of that profit potentially. Net income increased 3.7% to $222.7 million, which is over the $214.7 million last year. So very good increase, obviously, in net income there, which is what I like to see. I really like to see that. I really like to see that stuff. They explain the balance sheet. We'll go into it, but they say merchandising inventories totaled $1.3 billion. So a little bit more in inventories than they had last year. So what else do we have here? Increase in total inventory was driven by 80 new stores total for the full year. Crazy stuff. Company ended with $502 million in cash and cash equivalents. That's crazy. That's some crazy stuff. So that's what I would call cool stuff. We talked about the share repurchase. Obviously, 13 new stores that they mentioned here. So very cool stuff. Increase in square footage as well, which is pretty interesting. Obviously, that's just increased number of stores. So you gotta love that. For the outlook for this full year, fiscal year 2020, they're expecting 75 net new stores and executing 15 remodel and or relocations. Completed approximately 42 store refreshes, really just modernizing them. I mean, we're going through a store reset right now, 100% remodel. So that's the thing with retail. You stay up with the industry. That's how you do well. You get people interested by making some good stuff. Good stuff. You want it to look fresh for your customers coming in. We increased total sales by approximately 7 to 8%. That's what their goal is, at least. They want to achieve comp sales growth of 3 to 4%, deleveraging operating income margin rate to a range of 70 to 80 basis points. Deliver diluted EPS, obviously we talked about there. Incur capital expenditures of 280 to 300 million is what they're expecting. Depreciation and amortization expense between 310 million and 320 million, and net interest expense of approximately 9 million. But again, they say does not include anything about coronavirus. So I would say now I would like to look at this balance sheet, and we can wrap this bad boy up after that. So you see from a total current assets perspective, this company has increased it year over year. Right now has $2 billion in total current assets. From a total assets perspective, they've got $4.86 billion. If we're looking at liabilities, total current liabilities of 1.1 billion. So again, they've got over a billion, or nearly $1 billion more in total current assets. And this is a company, mind you, only bringing in 10 billion in revenue a year. So that's a lot of money. And then from a total liabilities perspective, they have about 3 billion. So again, about 2 billion more in terms of total assets. That's just crazy. You like to see that. So total shareholder equity of 1.9 billion. That's just crazy stuff. That's all I can tell you. This company's run super well, and I really want to get into this stock. I'm really interested in this. They're definitely opening new stores, no doubt. One of those new stores that they mentioned in this quarter would be one right by me, actually. So I know personally about the expansion of this company for sure. I've seen one get built in the past couple months here. So I haven't been inside, obviously, because it's not necessarily my cup of tea, for many reasons. But regardless, I really want to get into the stock, and I think this recent pullback in the market is a fantastic time to do it. And I'll plan on adding this one to my portfolio in all honesty. So we'll see how that goes, but I do think I'll be adding this to my portfolio. So hope you enjoyed, and I will see you on the next one.